Hey everybody, we're back today with another session on how we can use your financial metrics, your books, your financial statements to make business decisions off of. So it's coming from a client call. I had just come off a planning call for one of our construction company clients and was having this discussion around, hey, 2025 has ended. Let's do a look back at 25 and set targets for 2026. Some of my findings were quite shocking just because this client and us, we've only been working for 90 days. And some of the responses that I got from the owner, like he had all the pieces of information, but was not able to put it together to start doing some forward-looking planning. So if you're a business owner in the real estate space, you might be a builder, a construction business where you do third-party jobs. You might be a flipper. This might be a relevant conversation for you, a relevant framework for you to set some targets for this 2026 year from a fractional CFO perspective. Like this is what we do with our clients month over month. So I wanted to record this session as a value add for our clients to see if this resonates with you. And if it does, you might catch yourself with some frameworks in here that are super helpful for you as well. So looking at your numbers isn't the same as using them, which is fair, because if you're just working with a bookkeeper, you might be getting financial statements that are sent to your inbox as PDF attachments or Excel attachments. And you might look at it, but you're like, okay, that income is kind of all over the place and expenses are too. I see the bottom line number. I see some issues with the reporting. I don't actually know if this is reliable data, one. And I don't know, even if it's a reliable set of financials, maybe it's too old, maybe 30, 45 days have passed and you can't really use it. But today's decision making, two, or number three, the data is accurate, but you still are not sure what it's telling you to be able to make forward-looking decisions based off it. So we're going to cover all of those things today in this session. Real quick, this session was actually built around this conversation I just had with one of our business owners, Josh, who came into the CFO call. I just had this call this week. Why did we lose money on these 8 jobs? Also, we wanted to know how many jobs we did for the year. So this was before our call. I actually didn't even ask for them to do this yet. Although we had the data to be able to pull this information ourselves, they went a step further and went quite a bit in detail and pulled this data out, which is actually a step ahead than most of our business owners who may not even have clean financial statements to look at this type of reporting. Now, if that's you, we can certainly get you caught up on your books and get you to where you can rely on your financial statements to make those decisions. And if you are a person who keeps your books pretty tidy and you can look at your financial statements, then this next step definitely applies to you. So let's take it a step further. From there, they were reviewing numbers, but I was trying to see if he had been running the business with those numbers. Just yet, for 2025, in that year, they were not really using those metrics. And essentially, if you're looking at it at year end, it surely would have been more helpful to look at it month over month or quarter over quarter. In his case, as is the case with a lot of our business owners, jobs that were above profitability. So I talked about that, like the high performing jobs, right? The bottom jobs that not only did not make margin, but they were in losses, right? So I asked him, hey, did you use these insights to set department level targets for each of your teams? And he said, no. Said, I actually have never done that. I don't even know how to do that. And this is very surprising to me, right? Because we are essentially the only reason we will look at historic trends is that we want to learn from that and we want to set forward-looking targets. If we cannot take the data that we know to be true from the previous 2 quarters of previous year, depending on the type of business that you're in, if you're a very cyclical business and you limit the amount of time that you would look back, you want to inform future decisions based on historic data. That's the only point of look, obviously tax reporting and banks look at it. But you as a business owner, whatever is historic. The only reason we care about it is we want to be able to set future targets based on what we see in our historic financials and our trends, right? That's the whole point. So the problem is that they're looking at KPIs, they're seeing trends, they're taking notes, and then they're doing nothing. So that is mainly the gap that can be filled, and also the gap that will make a material difference in Josh's business. Could he actually bridge the gap between what is and what he wants to be in the future, right? The core truth is that just the awareness of the targets does not change any behavior, and the data alone does not drive decisions. First of all, as a CFO in their business, my first job is to actually create the clarity that the owner needs so that he can then set targets at a department level and drive the decision he needs to drive for each department being that he's sitting in the CEO seat. Now, I will say in his case, he is an operator, but he's not bogged down as the operator, which is a huge ask, right? If you're really the operator and can't even think about these type of decisions, that might be fundamentally the issue that you have to solve for. But again, the insights from the data really should get targeted. So this is what we see. Here that we're targeting. That then leads to decision making, which is exactly what we want. And then this is very common. This is more common than you think. I see this across businesses. Most businesses, they look at reporting. If you open up those files. So most of our businesses think there's a reporting. I'll give it to my CPA at the end of the year. A lot of businesses hold meetings, internal meetings with their team members. They talk about margins even, but they don't set projections. Like this is where the gap is. They don't set projections. They don't assign targets to specific people and departments. I mean, a department might be one or two people, but nonetheless, like if you got one sales guy, you still need to set targets for that sales guy, even though he's a department of one. And lastly, they don't change behavior, right? So we're looking at something, it's like it would be the same as going to having your labs drawn if you're somebody who cares a lot about your health. You draw your labs, you look at the data, and then you go back to the old ways of just living life. Like it does not change any behavior. The whole point of tracking anything, even health metrics, is that you would see what it says, infer it, understand the metrics, and then set targets. And like, okay, this is where is baseline, this is where I want to be. This is what I have to do to get there. Business is no different, right? It's exactly the same. So why is reviewing not enough? So financials are always delayed, often delayed. At the very least, they're 15 to 30 days delayed. A lot of times you might be preparing, your bookkeeper might be doing financial statement reporting based on what your CPA wants to see or what the bank needs to see. But we want to make sure that this is now a living document that you can grow your business off of by insights that you gather, not just a static report that's provided to a third party like a CPA firm or banks. And frankly, we do tax reporting for our clients. So we need those reports from a tax perspective, but I'm helping you step into the CEO seat so that you can see the difference between having this data set that is under leverage and how you can leverage it to make better decisions. The difference between an operator and a CEO is your ability to understand your market. Of course, if you're in the real estate flipping space, you understand this very, very clearly. If you're in the construction space, where you service third-party jobs, you generally don't see a downward trend unless, there might be a key piece missing. Most of our construction business owners are busier than ever. Flippers, different market trends and different bottlenecks. But if you're sitting in the CEO seat, you need to understand your market, and then you need to understand your strengths as a business so you can build in the gap, right? So a concrete example would be for Josh, he needs to be able to go look at his average margins. But the second part of this is in his market with his crew members, what are the jobs that are most profitable? Is there a trend? And then if those, like let's say kitchens and bathrooms are most profitable, I'm not saying they are, but let's say they were, then he needs to be able to match his marketing efforts to his marketing, to his geographic location. He might hit a limitation pretty quickly on how far he can travel to do those jobs. Who are his competitors in the market? And third, what is the crew capacity to be able to fulfill those jobs? So you start to see your internal data, which is just one marker, but you can use that to then set targets based on everything else that impacts, that's marketing, that's crew member size, that's your ability to fulfill your current jobs and take on more jobs. I don't know where you're in the project completion cycle, but it becomes a cash flow is another one, right? So operators, they focus on the execution, they're chasing tasks. So this might look like you might be hyper focused on what you currently have in the pipeline and making sure that jobs get done on time. That's very much, it is revenue focused, but it's not creating additional new revenue, right? CEOs are going to focus on the gaps. They're trying to pull themselves out of the weed, although they get sucked back into the weeds. I know this because I run a business myself, but you're trying to elevate yourself out of the daily grind of everything that needs to get done. And you're looking at these high level numbers, these metrics to say, okay, it is January 2026. Where do I want to be mid-year? Where do I want to be end of year? Okay, let's backtrack that to monthly targets, backtrack that to weekly targets. What needs to happen to a daily target list to say, okay, if we're low on project volume, we need to create some new jobs. Or in his case, in Josh's case, he has a lot of stuff coming in the pipeline, but they have been behind on billing. They just haven't been able to bill because they were so hyper focused on getting all the jobs that were currently in the pipeline done that cash collection kind of fell by the wayside. And he felt that because he was having trouble making payroll. because, his AR had grown to where he had just not collected over the holidays. And you kind of see this, like anytime you have a cash flow problem, you're too late to the game, right? Anytime you start to see a slump in cash, it's because you have not actively managed the pipeline of how much cash is expected to be in the business at a given point in time. Because had he seen that 30 days ago with the cash flow forecast, he would have upped his billing 30 days ago. He just didn't see it coming. He was in operating mode and could not pull himself back to CEO seat. So CEOs are looking at gaps, opportunities, and strategy. Okay. There's a little bit of a ladder to build up to the CEO role if you're sitting in the operator seat. I'm not saying you have to go hire a COO, although some of our businesses have CEOs. If you're in both seats, we need to optimize both the financial reporting and the systems to really get you there. The key is that you need to build where your business is weak to capitalize on the market trends, right? So for example, if you know that I was just talking to one of our local business owners, he's a cabinet maker and he is busier than ever. Just cannot keep up with his demand. And his bottleneck is not the amount of sales he can generate, it's actually completion of the projects. He was saying it was the hardest thing to hire cabinet makers and they make mistakes and then there's wastage and there goes my margin. Like wherever the weakness is, not just the market, but your weakness as a business, like you need to be aware of that. I'm in the same, my industry of accounting and tax and CFO work. We have more work than ever, different than a flipping real estate business. But the biggest piece I have to solve for is talent. So every business has bottlenecks. You as a CEO, if you're too bogged down with operations of the business, don't have enough capacity to really think about these high level things. So here's a real world example, right? So I kind of have just went through this analysis of his data. The data was showing this, that the margin erosion was not job size. Actually, it was not, $30,000 job versus a $200K job. It was actually the execution mistakes. He was mentioning to me how pretty much all the projects where they lost money, they had ordered wrong parts or wrong materials. The cycle time went up because it just took them, reworking. Some of it, they had a concrete issue in another job where it wasn't, one of the subcontractors didn't do the best work and they had to redo it. So you kind of start to see these commonalities. Will they repeat on future jobs? They may or may not, right? Will you have another concrete issue? Probably. But is that going to diminish your margins? Probably not. Depends on what you're targeting. So in this case, he's not going to hire that subcontractor anymore not because he made a mistake, but because his response to the mistake was he wasn't willing to come back and fix it. Okay, well, now we know that's a problem in the business where we do enough concrete work where we need fair price subcontractor because that's part of what we bid. We have internal costs to be able to maintain our margins, right? So you are looking back so that you can establish metrics going forward. Okay, so the missing piece, targets turn data into decision, okay? Without targets, the trends that you see in your business are meaningless. Just seeing your gross profit margin or your month-over-month revenue, not very meaningful in of itself. People that you hire in your business are going to do their jobs. That's the nature of the owner versus employee relationship. And you will have the same outputs year over year if you do nothing. If you look at your historic data and make no changes, you will have the same outputs year over year. Actually, your margins are probably going to erode if you make no changes, right? So if your price is held constant and your costs are going up due to just natural inflation, then you should expect to make less money in a future year than you did the previous year. So here's how you set targets, right? It's practical and you need some specific steps. This is it. And this is exactly what we did in Josh's business. So we looked at the last 2 quarters and we removed any outliers. So winners and losers, we removed those. We looked at just the averages, right? So we set a revenue target of 1.8 to 2 mil. Actual margin today is 26%, and we're targeting a margin of 28 to 30%. For this specific business owner, we are not targeting growth for reasons I can't get into on this particular conversation, this shorter conversation, but we're targeting a plateau in revenue and we're targeting a 2 to 4% increase in margin. That's our specific target. This global target then becomes department level targets depending on the department that we're targeting. Right? It has to translate. A 2 to 3% margin improvement, it does not require more work, right? Same velocity of sales. It often can come from just pricing increases, which we're implementing, and it compounds as the year goes on, right? So every future job is getting bid on new pricing models than what we've been bidding at. And we're going to see where the market is, the ceiling is in price improvements, and see how we can manage continuing to still hit our target on revenue, meaning equivalent sales, but higher pricing. Now, costs are going to go up. So we might still not see the margin improvements. So inherently, we're going to have to do better work, meaning actually improve margins by being more efficient. So it's both. It's multiple variables, right? So here's how to break down these targets. This is the second step. So company goals don't move companies. Role level targets do. So just because a CEO comes on, your monthly meeting and he says, hey guys, we've been doing 26% margin. We're going to target 28% margin. Let's get to work. That doesn't change any behavior. So for specific, and these are specific targets that, again, setting for this business as examples for you guys, not bids, signed contracts of 150K. Some months are higher, some are lower. That's an average. We need at least 150K of new revenue signed contracts. For project managers, our biggest bottleneck, we're going to set targets that are actually tied to compensation. So right now, the project managers just get paid a fixed amount. There's no accountability. And this is probably the biggest bottleneck in this business, is that the project managers are running projects and they have no pain associated with when projects lose money. So we want to give them upside and we also want to give them downside. That's what's going to change behavior. And then the back office or admin is going to make sure that cash is actually getting collected. There's some billing changes and some process changes that we're going to make that are going to speed up part of how we're collecting cash, because in his business, payroll is the biggest expense and not having cash collected is very painful just because he has a pretty large team. So step 3, I gave some of this away already, but step 3, we have to tie targets to behavior. What actually drives change? We're going to clearly set targets, and we did for the sales department, but more so, there's more departments that we are going to set targets for that are not covered here, but these targets need to be measurable and they need to be reviewed at the end of every quarter. We're going to do a monthly review of set targets, not necessarily for performance, but for bottlenecks. Hey, this is a target, 150K of sales. It looks like we've only closed 100K. What's going on? Are we as a business not supporting enough advertising and marketing, or are leads falling by the wayside because you're too overwhelmed and can't answer everybody who's reaching out to us and we have missed sales? Right? Time incentive-based comp to target outcomes. We talked about that with the project manager. That one always drives the outcomes that we want, positive or negative. Either you have project managers that don't work out or project managers that start to work the way it should because their comp is tied to margins. Here's some more accountability in practice. Here's some examples, right? Project managers' bonus is tied to margins and timelines. We know cycle time has a direct impact on margin, so we need to pay close attention to that. Sales targets per sales rep, very common. Department level sales targets. So what I'm saying there is we need individual sales targets. If you have just one member team in the sales, not a big issue. If you have multiple people, then you need both individual and department targets. I like doing a tiered sales comp. So, minimum sales needed, a lower comp, and then it tiers up as they sell more, they make more. We are setting cash flow targets as well. And I manage the cash flow forecasting on that as their CFO. So closing very quickly here, a couple more key takeaways. Why owners get stuck. Right? It's because they don't know how to understand the financial data, or they have unreliable historic data. They don't even have something that they can look at and say, yes, that's an accurate representation of my business. That's like the most common one. So we need a clean book. Sometimes they have that, but they don't know how to set KPIs. That's Josh. Sometimes they see the KPIs and they see the metrics, but they don't know what makes sense for their business. They might see somebody else in their industry doing specific margins, but they can't really translate that to their business. So this is where owners get stuck and can't translate data into decisions for themselves and their teams. This is what financial clarity looks like. So monthly forecasting, projections, both on sales, gross profit, and net profit. 3 key numbers, we need those. Also cash. Quarterly adjustments, right? So end of first quarter, the quarter ends, you look back, you measure performance. Don't get emotional about this. Example, 150K a month in sales. The first quarter, it looks like we're landing at 120. Okay, what's going on? Do we not have enough velocity of leads? Again, or are we too short of people? Do we need 2 sales reps? Don't know the answer without looking at setting targets, looking back 90 days to problem solve for that department. Early warning signs, right? I gave the example of cash flow. So had we had the forecast, which we didn't at that time, we didn't have enough clarity. Had we had the forecast in place, we would have seen that in 30 days, a lot of jobs are going to get completed, the cash is going to get collected, and the next set of jobs doesn't start till after the holiday. We're going to have this tranche of time, this small gap in time where cash is not getting collected. And as most small businesses are on cash, you're going to have a problem. Early warning signs, department level target. That's 4-prong clarity. that you can take away from this. Okay, the shift. So we are going to shift from reviewing numbers, looking back, to looking at numbers and running the business with those numbers, using that as a way for us to dissect current performance, current targets, and then saying what makes sense for your business in your industry, what is reasonable in terms of growth and margin improvement. This is also where questions get answered when clients ask me, hey, I'd love to hire this next hire. I just don't even know if I can afford it. Or I would love to step out of the operator seat. This is a super high level, right? And maybe towards the legacy part of your business where you've been running it for 20, 30 years. You're a little bit tired of running the business. You would love to exit without selling. You're thinking, man, if I could transition somebody into my business over the next 5 years, that would be amazing. How do you do that? You need processes and steps. If you want to move from being an operator to a CEO, don't just look at your numbers, understand the gap. This is kind of a quick recap, right? Understand the gap between your business and the market and make your next moves there. So if you want clarity on margin, clarity on your targets as a business, really help you step into the CEO role with numbers-based approach, where you have somebody in your corner who can really advise from a cash flow and accounting perspective, sit in like the head of accounting seat, really kind of oversee a bookkeeper, bring this all together on the finance side of the equation and let you sit, help you enhance your role as a CEO. That's us. So reach out to us. We'd be happy to have a conversation to see if you're a good fit for how we serve clients. We'd love to work with you. Yeah, and reach out to us. Thanks.